Learn from the best REIT manager. So the intent of recording this video is actually to share my reactions to the Suntec AGM minutes and what it means if I'm a shareholder. You definitely will agree with me that it will also be worthwhile to learn from other REITs so that we increase our exposure and our experience. But as of recording, just want to declare I am not a shareholder, so I couldn't attend the AGM. Thus, I relied on their AGM minutes to learn. So first question is the financing cost written in point 2.4. For the full year of 2024, the manager expects the interest rates to continue to be elevated at above 4%. How am I moving or continue to invest in REITs is definitely these next two reactions. First, any interest rate cut is a bonus. That's the first thing. Second thing, I assume that the interest rate is at 5%, and I want to know what's the maximum finance cost that my REIT operations will incur yearly. So it will definitely simply be the amount of borrowings multiplied by 5%. Then I'll compare this figure with the finance cost indicated in the annual report, and I see what's the big difference. So it gives me an idea how much more potential costs that my REIT will incur. Second question is found in the divestments written in point 2.5. So it explains here, the CEO explained that their mature assets are mainly in Australia, and Australia office capital markets have been very quiet. In 2023, the transacted value of office assets was 50% below the long term, which is 10-year historical average. Please pay attention here, okay, because you might want to take note of the second point that I'm going to say. So in the first point is we know that REITs is a game of spreads. You need to earn the difference between the borrowing cost and the rental income. We're earning this spread. So the health of my REIT depends on how well my REIT manager plays this game. So for Suntec, I ever recorded this video, right? Why selling their Australia asset might be a better move. The second reaction is even more important, and is regarding this statement. In 2023, the transacted value of Australia office assets was 50% below the long-term historical average. Can the valuation of offices sink as much as 50%? So that's the first point. And more importantly, is Suntec portfolio stuck with their existing Australia portfolio? So even in the annual report, though the valuations has been coming down, but is the value of those Australia assets still be able to hold up at the current levels, right? Because you have an independent assessor that's assessing the value of those properties. Is it possible that Suntec may record a book loss regarding these assets, especially in Australia? So that's the second point. The third point is about point 2.9, because I feel that explains the cause of the current situation that Suntec REIT, especially the Australia portfolio, is facing right now, which is the dropping valuations. This has pushed Suntec REIT nearer to the regulatory limits of 45% gearing and a minimum of 2.5 interest coverage ratio. So for Suntec, its ICR dropped from 2.6 to 2.1, and currently Suntec REIT current gearing is about 42%. This means that it only has a 3% headroom. And what could this mean for Suntec REIT unit holders? I record that it might not be that scary, right, to reach the regulatory limits, but I'll still recommend you to watch this video so that you give yourself a peace of mind. Oh, YouTube recommended this video because it's relevant for you.